There is a 3-digit number that decides whether you can rent an apartment, buy a car, get a mortgage, qualify for a credit card, and in some states, whether you get the job you applied for. It follows you everywhere. It updates without warning. It penalizes you for things that have nothing to do with whether you actually pay your bills. And it is owned, maintained, and monetized by a single private company that generated over $1.7 billion in revenue last year, selling your own financial behavior back to the institutions that want to evaluate you. You've never voted for it. You've never agreed to be scored by it. You were just born into a financial system where it already existed, already mattered, and already had rules that nobody explained to you until you got rejected for something. I'm talking about the FICO score and the credit scoring industry that built itself around it. Here's the thing. The FICO score was created in 1989 by a company then called Fair, Isaac and Corporation, now just called FICO. And at the time, it was genuinely useful. Before standardized credit scoring, lending decisions were made by local bank managers using gut instinct, personal relationships, and a level of subjective bias that was, to put it charitably, not always in the applicant's favor. Minorities were denied loans at dramatically higher rates. Women without husbands couldn't get credit. The system was broken in ways that were obvious and ugly. A standardized numeric score applied uniformly felt like progress. And in some ways it was. But here's what happened next. FICO didn't stay a neutral measuring tool. It became infrastructure. Banks built underwriting systems around it. Landlords started using it. Employers started pulling it. Insurance companies started pricing policies off it. And somewhere in the process of becoming the operating system of American financial life, FICO became something it was never supposed to be. A gatekeeper. One algorithm. One company. One score. Deciding access for 200 million Americans. Let's get into the mechanics because this is where the comfortable story starts to fall apart. Your FICO score is calculated from 5 categories. Payment history is 35% of the score. Amounts owed, specifically your credit utilization ratio, is 30%. Length of credit history is 15%. Credit mix is 10%. New credit inquiries are 10%. And on the surface, this seems reasonable. Pay your bills. Don't max out your cards. Don't open 12 new accounts in a week. Sounds like common sense. But here's where it gets structurally strange. The second largest factor in your score, 30%, is credit utilization. The ratio of your current balance to your total available credit. The conventional wisdom is to keep this below 30%. Below 10% is even better, which means the system is actively rewarding you for carrying balances you don't pay off immediately, because zero utilization, paying your card off every single month and never carrying a balance, can actually hurt your score in certain models. You read that right. Being too responsible with credit in the wrong way can lower your score because the algorithm wasn't designed to reward financial health. It was designed to predict repayment behavior for lenders. And lenders don't make money from people who never borrow. And then there's credit mix. 10% of your score is based on whether you have a diverse variety of credit products, a mortgage, an auto loan, a credit card, a personal loan, not whether you need them, not whether they made financial sense for you, just whether you have them. The scoring model is literally giving you points for holding more debt products. which is convenient if you're a financial institution that profits from people holding more debt products. Now, here's the mechanism that makes this whole ecosystem function. FICO doesn't just sell scores. FICO sells scores to lenders, sells score monitoring products to consumers, sells score simulation tools, sells score improvement products, and sells consulting services to the same financial institutions whose lending products feed data back into the model. It is a feedback loop that is, to use a word carefully, beautiful. If you're FICO, you own the algorithm. The algorithm requires certain financial behaviors. Those behaviors require financial products. The products generate data. The data feeds the algorithm. And every actor in the chain pays FICO for access to the output. Let's talk about a person we'll call Marcus. Marcus is 24, just finished college, has no debt, has never had a credit card, and has paid every bill in his life on time with his own money. By any reasonable human definition, Marcus is financially responsible. By FICO's definition, Marcus has a thin file. No score or a very low one, because the model has no data to work with. Marcus applies for his first apartment, rejected or asked for an extra deposit, applies for a car loan, high interest rate, applies for a credit card to build his score, gets a low limit with a high APR, has to spend the next 2 years deliberately manufacturing financial history, buying things he doesn't need, carrying balances he'd rather not, managing utilization percentages, just to prove to an algorithm that he is creditworthy. Marcus didn't fail the system. The system failed Marcus, and then it charged him for the privilege. The historical rhyme here is uncomfortable and precise. In the 1800s, private credit reporting agencies called mercantile agencies began tracking the creditworthiness of American businesses and consumers. They were opaque, inconsistently accurate, and notoriously prone to including rumors, personal vendettas, and racial bias in their reports. Congress eventually stepped in with the Fair Credit Reporting Act in 1970, which gave consumers the right to see their reports, dispute errors, and hold agencies accountable. It was framed as a landmark consumer protection moment. And then 30 years later, a private company rebuilt a more sophisticated, more embedded, more mathematically defensible version of the same gatekeeping infrastructure. And this time, it became so deeply woven into financial life that regulating it feels almost impossible without pulling a thread that unravels the entire lending system. The errors problem deserves its own paragraph. According to a Federal Trade Commission study, roughly 1 in 5 Americans has an error on at least one of their 3 major credit reports: Equifax, Experian, and TransUnion, the 3 private companies that collect the raw data FICO scores are calculated from. 1 in 5. That is 40 million people potentially being scored, priced, and gate-kept based on information that is simply wrong. And the process for disputing errors is deliberately friction-heavy. You submit a dispute, the Bureau investigates, which usually means they contact the original creditor who reported the error. That creditor confirms the data they already submitted. The Bureau closes the dispute as verified. The wrong information stays. Repeat. Here's the uncomfortable truth. The credit scoring system is not broken. That implies it was designed to do something it's failing at. The credit scoring system is working exactly as it was designed, to quantify risk for lenders, generate revenue for the companies in the ecosystem, and create a compliance framework that keeps consumers engaged with credit products as a permanent feature of financial life. The fact that it also determines access to housing, employment, and basic economic participation is a side effect that became a feature. Because the more the score matters, the more people need to manage it, monitor it, improve it, and buy the products that feed it. So what can you actually do? Here's the practical version without the anxiety spiral. Check all 3 credit reports annually at annualcreditreport.com, the actual federally mandated free site, not the one with the jingle. Look for accounts you don't recognize and balances that seem wrong. Dispute errors in writing, certified mail, to the Bureau directly. Keep records of everything. The paper trail matters if you escalate. Keep credit utilization below 10% if you're actively managing your score for a specific near-term goal like a mortgage. Pay the card before the statement closes, not just before the due date. That's when the balance gets reported. Do not close old credit cards even if you don't use them. Length of credit history is 15% of the score, and closing old accounts shortens it while also reducing available credit and spiking your utilization ratio simultaneously. Understand that credit score monitoring apps, many of which are free, make money by recommending financial products that are conveniently optimized for improving the specific score metric you're anxious about. The app is not your friend. It is a lead generation tool with a dashboard. And here's the part nobody wants to say out loud. The credit scoring system could be redesigned. Rent payment history, which is often the largest financial commitment a person makes, is still not included in the standard FICO calculation for most consumers, despite being a near-perfect predictor of financial reliability. Utility bills, subscription payments, and bank account cash flow data could all provide more accurate signals of creditworthiness for the 45 million Americans with thin or no credit files. The data exists. The technology exists. The reason it hasn't happened at scale is not a technical problem. It is an incentive problem. Because the current system, with all its friction and opacity, generates reliable, recurring revenue for the people who designed it. And that is, at this point, a familiar pattern. So drop your take in the comments. Do you think the credit scoring system is A, a necessary evil that just needs better consumer protections and more transparency, B, fundamentally outdated and due for a complete rebuild using modern data, or C, a privately operated financial gatekeeping system that will never meaningfully reform because too much money depends on it staying exactly the way it is? Because somewhere right now, a 23-year-old is being charged a higher interest rate on a car loan for the sole reason that they've spent their entire adult life avoiding debt. And the algorithm is calling that a risk